Get on in here. Let me check the YouTube real quick, brother.
Hmm.
On this nice Sunday, hope the weather looking smooth where you at.
Oh man, it's beautiful, bro. It better be beautiful. It was snowing the other day.
Bro, it really was. That was wild.
Boy, I like you're supposed to wake up and thank God and all that, bro. I ain't gonna lie.
Yeah.
That day, I was not thanking God, gang. I was yelling at God, gang. I was like, yo, you really pissing me off this early in the morning with bare foolishness. Blood clot, man.
Yo, that was wild. I'm not gonna lie. I was like, is it snowing? I'm in the office. Like, what's going on?
Bro, like I looked out my window, bro, and like it was like a movie. You know, in the movies where somebody sees something and they don't believe it, so they take off their glasses and like rub their eyes, bro. Mike, I rubbed my eyes mad hard, Mike. I was like, nah, I gotta be. Nah, I must have ate something. I must have been. Did I drink last night? What happened? I've got to be seeing things.
Right.
Like,
Like, this can't be real.
can't be, bro. I was rubbing. Open my eyes.
Yeah.
The snow on my car in April. Oh, that pissed me off, man.
Bruh. Hey, that's New England for you, bro. You know.
Mm-hmm.
All right. Looks like the YouTube is good too. So just want to make sure there's one last thing here. All right. Let's see here.
See a
Perfect. So,
message in the chat.
oh, you see a message? I was just about to ask you if you
Yeah.
see one. I just put one in there.
Okay, yeah, I saw it.
What is that?
Yes, sir. That's what I said.
All right. All right. Perfect. Perfect. So, all right. You can see that then.
All
All right. So,
right.
if y'all got any questions, comments, you could definitely throw it on there in the YouTube or in the Discord as well. You know what? I'm gonna do one last thing. I'm gonna also share this to the IG so they can have this too.
Oh, smart, smart, smart.
You know what I'm saying? Then we good. Yeah, man, it's a lot going on though, bro. I'm glad we're able to make this a monthly thing. I know the people, everything, especially now, everything is changing so quickly.
Mm-hmm. Ridiculous.
So let's see. Boom.
Everything
We're gonna share
changing,
the
man. We had to
TGW
stick.
page. You said what?
I was just agreeing with you, bro. Everything changing, man. We had a damn ceasefire. Now we're trying to. There's a blockade going on. I don't know, man.
Hmm.
Just pick your poison at this point.
Bro, it's like, when is enough enough?
Mm. Question of the year, right there.
Like, I just don't get it, bro. It's one of those things we're gonna have to deal with, and that's why we're doing this seminar today, so that way we all know how to just maneuver through these uncertain times, you know.
Yep.
So hey, but I think I'm ready to get into it. You good, brother?
Yes, sir. Let's go, brother.
Perfect, family. So boom, welcome back to the 2026 Portfolio Blueprint. This is volume two. Back for another one. I'm the Wolf. Got my brother DY here with me. You know what I'm
Yes, sir.
saying?
Back at it again, man.
Absolutely, absolutely, family. So we want to definitely make sure that we're bringing these wealth seminars to y'all on a monthly basis, and it's not going to always be about stock market or credit. It'll be about anything. It's even like your mental health when it comes to investing and how to deal with money. So this is something that we want to make a normal thing. So please share, like, comment if you can to get this video out there. All right, perfect.
Yes, sir.
Let's get into it, brother.
Yes, sir,
All
man.
right. So, this seminar, why are we having it? Again, we want to make sure that financial literacy is becoming a normal thing. Volume one, we taught how to invest, and some people may have took something from that. You also may want to build on top of that. So that's why we have volume two today. We're just going to show you how to build a structured portfolio in 2026. Now, we just talked about it. The world has changed dramatically since then, and that was just like a little bit over a month ago. So, your strategy, you would definitely want to make sure that that's reflecting what's going on now. So, what has happened since Volume One? It's a lot, family. We got a whole list here for y'all.
Mm-hmm.
Now, February 28th, U.S. and Israel launched airstrikes on Iran, killing the supreme leader Khamenei. The Iran closed the Strait of Hormuz, cutting off 20% of global oil supply. That being said, we saw oil surge past $100 a barrel, and gas has even crossed $4 a gallon nationwide. But my cousin was just here. She said she spent over $5 a gallon just to drive from Jersey to CT, and she spent like 73, $75 just to fill up her tank. It's wild. It's wild,
I would
bro.
have walked.
Like, bro, what? It's it's crazy out here, fam. So we definitely understand the pain. We are going through it. On top of that, the S&P 500 just posted its worst quarter since 2022. The Nasdaq has entered correction territory, and it's just been a fragile 2 week ceasefire that's been brokered between Pakistan on April 8th. And that's already under strain because now they're talking about, hey, this person didn't agree to these terms and they're breaking certain rules
Mhm.
that we agreed on. So that's just another thing we got to worry about that can make everything more uncertain again. And then lastly, the U.S. Navy destroyers entered into the Strait of Hormuz for a mine clearance, and that was on April 11th. So I'm not sure if we got too much news on how that's been forming, but it's something that we're also looking out for because we don't know what that could entail. Now, the market conditions right now, markets have rallied on that ceasefire news. So it's been the best week since November recently, and it's just making things a little bit more volatile as you're seeing the market dump a bunch, and then you're also seeing it rally up just because of one little news headline. So it's still just a uncertain time. And with the peace talks happening, you just really never know what could happen just because certain people aren't acknowledging or staying true to the word that they agreed on between US, Israel, and Iran. Also, the Fed is stuck between cutting rates and fighting war driven inflation. So now the Fed is between a rock and a hard place. Just they don't know what to do because there's just so much stuff going on politically, economically. So just like they don't know what to do either. And the most important thing, which is us, the consumer, sentiment, that just hit an all time low. So the consumer is very uncertain about where their money is going, how expensive certain things are, like groceries, uh, shoot, even gas. What we just talked about, the most important thing, your
Yep.
utility bills. So all of this stuff has been going up just due to all of the economic stuff happening. Now, this is definitely not the time to just invest randomly. This is the time to really have the blueprint that we're going to give you guys today. So please take any notes that you can, ask any questions that you may have. We'll have a Q&A at the end as well. So yeah, it's going to be a lot that we're going to go over today, fam.
It's a fact.
Alrighty, perfect. You want to go over this one, bro?
Yeah, brother. So here's what we gonna go over today, man. Number one, asset allocation. You know what I'm saying? We're gonna go over exactly what it looks like to structure your portfolio across multiple different asset classes. Either that be ETFs, individual stocks, crypto, bonds. We're not big bonds guy, but if you're interested in that, that's what we're gonna talk about today. But we're also going to double tack on the 2026 core satellite model that we touched on in our last seminar, which is pretty much our framework that breaks down your portfolio into specific buckets. So that way it's easy to maintain and easy to understand on all levels. And then third, we're going to go over the sectors that have the most conviction right now. Like Mike was saying, there's a lot of volatility in the market with the cost of oil in Iran, and now we're sending blockades in, whole types of stuff. But in these types of trends, is volatilities where you find real opportunities with strong companies, and those strong companies are sometimes hidden in weak, beat up sectors, specifically software. Software is OD right now; it's crazy. So we're
Mm-hmm.
gonna teach y'all how to find opportunities in that. The art of dollar cost averaging on top of the advanced entries. We're going to teach y'all exactly what it looks like to consist investingly, but also when you hit a certain support line on stocks, to put in a little extra. We're gonna teach y'all how to dollar cost average consistently, but also time the market correctly, so that way when you have to, so you know when you put in a little more than what you usually do. For me,
Mhm.
position sizing. We're gonna teach y'all how to not get wiped out. It's a lot of y'all problem. Y'all see a meme coin and put your whole life savings in it. We're gonna teach y'all how to position size each of your trades and your investments using the 20% rule. That if you're in the Discord, you know what that is. We talk about it all the time.
Mhm.
Boom. We also gonna go over our exit strategies and rebalancing because we're in the stock market to obviously build wealth, and that involves selling when we're at highs. Okay, so we're gonna teach y'all the exit strategies that we use to not only take profit but also to keep the wealth building while we're taking profit and rebalancing our portfolios based on where the market is going. And then we will talk about taxes. But keep in mind, we are not accountants. Do your own research on everything accounting wise when it comes to taxes. But we're gonna teach y'all exactly what we know about taxes and what we utilize in our strategies when it comes to wealth building. There we got Q&A. If y'all got any questions from me and Brother Wolf, we're gonna be here for y'all.
Absolutely, absolutely. And lastly, before we definitely get into the heavy details of everything, definitely want to say this is not financial advice. Please, everyone, do your own research after this video. Take everything that we're saying with a grain of salt. So at the end of the day, you need to definitely do your own research and be confident in anything that you're learning. All right.
It's a fact. All right, boom. So we gonna get into it, y'all. So asset allocation. Exactly what is asset allocation, right? So what I mentioned earlier, asset allocation is essentially where are you diversifying your money into as far as investments? Are you going 50% stocks and 50% ETFs? Are you going the usual, I think it was 60-40 rule where it was 60% ETFs, 40% bonds? What are you doing and what vehicles are you using to build wealth? Okay. And for me, in my opinion, for us to think of your wealth, asset allocation is way more important than just picking the right stock, right? Because it gives you the opportunity to have a lot of gain to your upside, but also it minimizes your downside. So that way you don't open your portfolio one day, you down 50, 60%.
Mhm.
So that's why, in my opinion, allocation is always going to be stock picking because you're going to survive the bad months. Like now, there are people that are down like 40, 50, 60% because of what's going on in software and the tech industry right now. So allocation prevents that from happening to you. So that way you have a calm mind when it comes to the stock market. It reduces the volatility. So you don't got to check your portfolio every 5 minutes or grow gray hairs by the time you're 25. And also, in markets like this, it's easy to relax. You know what I'm saying? Because in a market where there's a lot of war, there's a lot of disruption, there's a lot of headlines. Having a set portfolio that's allocated around multiple different vehicles allows you to breathe a little easier because you know no matter what happens, if Thanos comes down on Earth and starts punching the ground with the Infinity Stones, your portfolio is still going to be performing a lot better than another person may be who may be 100% into the video. You know what I'm saying? So
Mhm.
you have an ease of mind, but more importantly, in my opinion, it gives you the discipline to stay invested because you have that confidence that your portfolio can withstand anything that happens in the world and in the market. And that's 95% of the battle right there. Is staying invested when peer fees. When that fear and greed index is at one or negative something, what are you doing? Are you selling or are you holding strong and keeping your portfolio the way it is? And 9 times out of 10, those are the people who win. You feel me?
Mhm.
So that's the biggest thing with asset allocation. And right now, the biggest thing with war, energy, the tech market, there's a lot of opportunities here. So right now, it's important to understand where you should be putting your bread. We don't get into that.
Facts.
So boom, right? We got risk-based and age-based allocation. So for the longest time, your typical financial advisor at any firm has been saying you should use age-based allocation, subtracting your age from 100 or your stock percentage. That was the main thing that you would do to dictate if you got enough bread to retire and all that. But that is way outdated. All right. The real thing you should be considering when it comes to allocation before you get into putting your money into these different vehicles is figure out three things, right? Do you have an emergency fund? 6 months, minimum 3 months before you start investing aggressively. All right, because if you don't, and God forbid life starts life and you gotta some things you gotta pay for, now your whole portfolio is at risk that you spent a year stacking up. Because if you need the bread, you need the bread. So now you're gonna have to sell your Nvidia, you're gonna have to sell your Microsoft, you're gonna have to sell your Oracle just because an emergency came up. But an emergency
Mhm.
fund is meant specifically for that. So if you're investing into the market without having an emergency fund established, you're essentially just kind of playing with fire because if anything happens, you're gonna have to take money out your stock and you're back at square one. So that's number one you want to ask yourself. Do you have that? Okay. But when the market dips and you have that, you're gonna feel way more comfortable putting more into buying that dip rather than worrying about how you're gonna pay your bills. Okay. Second is, are you in survival mode or growth mode? And this one sits heavily with all us young people because it heavily revolves around debt. All right. If you in 30K, 40K, 20K credit card debt, and you all your cash flow every month is going towards this high interest debt, you are in survival mode. You're not in the capacity to even think of what investing in the stock market looks like. Okay. So before you even consider thinking about, hey, I'm a dollar cost average into this stock or this ETF, first figure out, am I surviving or am I growing? And if you're in survival, don't beat yourself up about it. 99% of Americans are. Okay. So that doesn't mean that you're terrible. You're never going to get out of it. All that means is you need to flip that mindset of the stock market instead of going towards your debt and paying that down as much as possible. So that way, now when you are prepared to get invested into the stock market, you don't have to worry about any collection agencies calling you or any negative marks on your credit report that could be affecting your investing or none of that. You could strictly just focus on growth. You feel me? So that's the second thing. Are you in survival mode or growth mode? And lastly, what's your timeline? All right. If you try and get rich in 5 years, you're going to take on a whole lot of risk, you know? So if that's your timeline, it's possible. People do it, but it's going to involve allocating a lot of money into specific sectors and specific stocks that could go to zero. All right. But let's say your timeline is 25 years, 30 years, you can sit back, set up your allocation of your investments towards ETFs, stocks, maybe a little bit of crypto, and then cool it. Okay. The longer the timeline, that's going to be able to absorb more volatility. The shorter the timeline, you're going to need more protection. You feel what I'm saying? Because if you try and invest in 5 years, and let's say something like now just happened where oil spiked up $100 a barrel, and you're having all this volatility with the Iran war. If you're thinking of a 5 year timeline, you're stressed right now because this could be year four for you. You maybe have what, 9 months left, 10 months left. You feel me? But if you have 25 years, like myself with Wolf Invest and I'll be teaching on Discord, we're chilling. We're like, hey, buy the debt. Put a little more chip on it. You know what I'm saying? So make sure you know your timeline because it varies. You could be 45, 50 looking to retire soon. So your timeline could look a lot different from myself and Wolf, who have 20, 30 years forward that we're looking towards. All right. But even after those three things, you also want to know if you're good, you're in growth mode, you have your emergency fund, what does your actual allocations look like now? So we're gonna have some tasks that we go through throughout the whole presentation. But one thing I ask all y'all to do if you walk away from anything doing this is look into your brokerage and see what your allocations are. Are you 100% ETFs? Are you 100% stocks? And if so, how can you implement the strategies that we're teaching that we do on a daily basis so that way you can improve your allocations and build more safety in your portfolio. You feel me? So take that and look into it before we get it all the good stuff, you know?
Yes, sir. Perfect. So let's definitely get into some of those allocations that bro was just talking about. This is going to be your 2026 core model, right? And we're going to divide this into four buckets. And this is just a way to maximize your growth while protecting that foundation. No matter what, when you're building a house, you need to have that strong foundation so that home can last for generations. It's the same thing with the stock portfolio. All right. So 60 to 70% of that overall capital is going to be in the broader markets, which is the ETFs. That's an exchange traded fund. And we talked about this, in our last seminar. This is the SPY, the QQQ, VTI. This is what all of the companies are trying to beat when they're talking about how they're performing on a year-to-year basis. Okay, this is where the heavy lifting is going to come from, and this is where the long-term wealth usually happens. I use this example all the time. Warren Buffett, 1950s, he put like $10,000 into the SPY. In 2020, around that time, that was worth $50 million. All right, fam, and that's just the overall SPY. So it says a lot on how good this ETF can perform when you have a long-term outlook. All right. Now, 15 to 20% needs to go towards your individual stocks. So these are the companies that you need to do your research on, and you need to have the belief that it's going to perform at a good rate for the next 5 to 10 years. Now, these are companies like Netflix, Microsoft, Nvidia, Apple, Google, Amazon, Caterpillar, Chevron, Home Depot, FICO, Realty Income. These are all really good companies that a lot of people have made money off of for the last 5, 10, even 20 years. Now, the risk with these, they're a little bit moderate to high just because they're individual and they're in their own sectors. So it's not like the SPY where it's a bunch of stocks in one. All right. Next is that 5 to 10% frame that needs to go towards the more high risk plays like crypto. All right, fam. So
Yes,
I
sir.
know a few years ago when you talked about crypto, people are like, yo, I can't get into crypto because it's just way too risky for me. The 70% swings is just too much. My blood pressure can't take it. Family, I get it. Which is why we're saying use the 5 to 10%. Now, these are the high growth plays like Bitcoin, Ethereum, XRP. But this is why you need to make sure that your sizing is small because of how crazy the volatility is in these crypto plays. And now the maximum risk, which is your options and your active trading, that needs to be about 1 to 5%. This is strictly for leverage, hedging, or just to make some type of premium while your money is just sitting around doing nothing. Now, if you're a beginner, we are always going to say use a paper trade account to learn how everything works first before using your own money. All right, it's super easy to just get into it. It's almost like gambling, so that's why you definitely want to make sure that you know how to do it first and that you're only using a small amount of capital to do that.
Facts.
Yes, sir. All right. Now, you may be wondering, how do I pick these certain plays? And the most important thing is you want to make sure that you have value over momentum when it comes to creating any type of portfolio. Now, we all need to start off as a beginner, no matter what. And there's a lot of mistakes that you can make as a beginner. You know, the first thing is getting into a sector that's hot, like you see AI happening. You're like, yo, I need to get into AI right now because everyone is making money off of it. But most of the time, you're getting in after the move has already happened. So the last thing you want to do is just chase momentum. You don't want to have that FOMO. All right, it's the fear of missing out. So chasing momentum is not what you want to do. You want to make sure that you're getting in before it even happens or buying something when it's already down. So the wrong approach is, going on Finviz or going on Yahoo Finance or Robinhood where it shows you the best performing stocks of the day or the best performing stocks of the week. And what you're going to do is you go in and buy it. And then you wonder why, why am I down 20%? Why am I down 50%? It says that this stock was green the whole week. That's not how you want to approach this, family. Now, the TGW approach is we want to find fundamentally strong companies where the market has been undervalued. So, for example, Microsoft, Amazon, these type of stocks right now are super undervalued, but they're really good companies, and it's not really running hot right now. So these are plays that we're looking at like, yo, I may want to put some money in these right now because it's down. Most people are not looking at it, and then when it goes up, I'm already in the play. I don't have to worry about buying it at all-time highs. Right now, you definitely want to make sure that you're using the sectors as context. So when we say sectors, we mean like energy, retail. You can look at AI stocks, so technology companies. These are different sectors that we looked at. You want to understand, why is energy surging? There's a war going on. It's harder to get oil across and through certain areas or certain regions. So that's why oil is becoming more expensive. Why is tech correcting? People are running away from more risky assets, so they're running to more safety. So that's just some of the things that you want to understand when it comes to these certain sectors. Also, you want to use fundamentals to decide your next move. Now, the fundamentals didn't change. The market just got scared. So that means there's a buying opportunity. And then when your fundamentals aren't actually working, that's a warning sign. So you got to be able to know, all right, let me get out of it. Let me try to go back to the drawing board because what I'm doing isn't working. And sometimes it'll happen like that. So you got to make sure that you stay true to what your rules are. Everything may not work. And some of the smartest people lose money in the stock market. And that's just something you got to be okay with. All right. And lastly, a strong company is always going to stay strong. Right. And that's not for every company. Obviously, there's some companies that do go down. But when it comes to the companies that you pick for your portfolio, you want to make sure that if it's a strong company, it needs to remain a strong company no matter what's going on. So overnight, a company is not going to become a bad company, right? You're not going to see Apple become a horrible company overnight. It's just it's not normal, right? So just because they're having a bad month doesn't mean you need to just panic sell and get out of it, right? That's why dollar cost averaging is so important. You're not throwing your whole entire life savings on one play. So it's just some of the things we definitely want y'all to use as far as your framework on how to pick certain stocks and ETFs to build up your portfolio.
Absolutely.
All right. Now we're gonna get into the portfolio visualizer. DY has that tab open, so he's gonna show you how that works. Super helpful.
Yes, sir. So it's a fire tool, y'all. It's called the Portfolio Visualizer, like Wolf said. And essentially, what it allows you to do is it allows you to back test portfolios. So for y'all that may not know what back testing means, back testing essentially means looking at how a certain stock or portfolio or ETF has performed throughout a certain time period. So in this case, this portfolio that I have here has been analyzed and back tested from January of 2017 all the way to March 2026. All right.
Hmm.
This is a super fire tool because when it comes to allocation and going over the four buckets that we just talked about, it allows you to actually see instead of me just going in not understanding how this could perform in the next 5 to 10 years. Let me look and take the same exact portfolio I'm ready to invest my money into and back test it for the past 10 years and see how it's done to give you that reassurance and confidence in your trade. But also, it allows you to compare different portfolios. So I'll give you a prime example. Right here, for my sample portfolio, I made one with Microsoft, Oracle, VOO, which is an ETF that tracks the S&P 500, and IGV, which is an ETF that tracks specifically the software in the sector. So the not the Nvidias, but the Salesforce, the even the Microsofts are in there, etc. And the way I set up my allocation was 40% individual stocks, so 20% Microsoft, 20% Oracle, and 60% ETF, so 30% VOO, 30% IGV, right? And I back tested it from January 2017 to March 2026. And it'll literally tell you what the annualized returns were. So here it says my portfolio returned 17.4%. And the benchmark relative, which is pretty much what I'm comparing it to, was the S&P 500 or the SPY,
Hmm.
and that came at 3.4%. So this
That's wild.
portfolio beat the market. It's crazy. So this portfolio beat the market by almost over 14%.
Hmm.
And then the risk side, and this is where you got to read this part too. This side, the drawdown tells you how much this portfolio pulled back during a certain time period from 2017 to 2026. So there was a time where this portfolio was down 32%, which is
Hmm.
wow. Okay. But this tool shows you this is the reality of investing. You feel me? You could have long term, you could have this 17% and you're beating the stock market. And that's something a lot of hedge funds can't do. They got billions upon billions of dollars. But it'll
Hmm.
also show you, hey, to get to this, you got to go through this. Okay. And this is what bulletproofs your mind. All right. By showing, hey, these are the same companies I want to get into. In order for me to get to this portfolio return and beat the stock market, I need to be prepared to see drawdowns like this. And instead of selling, buying more. So this
Yeah.
tool is super fire for that. And I had another portfolio here that was comparing it, which was all ETFs. And this one beat the stock market too. But we gotta be prepared for the redness like this. So this is an awesome tool for y'all to use. It's super helpful. And again, it trains your mind to actually think, okay, you know what? Let me see how this portfolio has done in the past, and let me see how I think it will perform when I get into it.
Now, for sure, I love that too, because one of the most important things that some people don't even think about, you may see the 17% on a yearly basis, but we also gotta take into effect of compound interest. So
Mm-hmm.
even though you're making 17% a year, if you put in the compound interest, you're making a bunch of money because it's building up. That was like a 10-year time frame. So that's a lot of money being made if you're steadily making 17% on every single year. That adds up, fam. So that's super
Yep.
cool to see. I really like that one. A lot of people don't mess with that
Uh,
one.
yes, sir, bro. And this will show y'all exactly how to get here, because it's gonna ask you to like sign up for something. You don't gotta do that. If I go to the homepage portfolio visualizers, all you gotta do is go to tools here and click back test portfolio, and this is where
Mm.
you can build it. You end up at the same page I was at. All you gotta do is click edit portfolio, and then from there you can select your tickers, set up your portfolios. You can compare three portfolios at once, all that. So you do not have to pay for anything. It's a free tool, just to let y'all know.
Hey, family, the numbers don't lie, fam.
Numbers don't lie, bro.
Oh, that's tough, bro.
Yes, sir, bro. So yeah, Wolf was dropping gems. For me, we dropped y'all a good tool right there. But we also got to talk about when it comes to these sectors and these different spots in the stock market, right? Where are the ones we should be looking at? Where are the undervalued opportunities that we were just talking about, right? Again, the question isn't, yo, what's hot now so I can go buy? It's what's strong but underpriced. What's doing perfectly fine, but people are emotional about it. That's what we really want to look for, right? So some prime examples of things that are hot right now is the energy sector. Oil is past $100 a barrel due to the Strait of Hormuz being closed. Goldman Sachs saying that it could be above $100 if restrictions continue. You know what I'm saying? So this right here is a prime example of energy running. If you were invested in the oil before this happened, you made a killing. But if you weren't,
Hmm.
this wouldn't be a good example of an undervalued opportunity. I actually had a guy at the gym yesterday I was talking to, my boxing guy. He was doing some pad work and all that. And we were sitting down talking. He was like, "Yeah, bro, what do you think about the oil commodities?" And I was like, "Honestly, bro, that ship already sailed. It's out of there, so you can consider it, but it wouldn't be a good entry point." So that's an
It's not a home
example of a
run right now.
sector. Absolutely not. Hell no. Whoever's in it though, if you were in it, God bless your heart. You ate, but
Oof.
it's
Yeah.
not the play as of now, you know. But things such as healthcare, with an aging population in the U.S., biotech innovations within the industry, the big hot words are the GLP-1s, Eli Lilly just getting an FDA approval for a weight loss pill. Healthcare is in the correction type of area as well, but the numbers could be mumbling if you look into the proper companies, either it be the UNH or the Eli Lilly's that we talked about. Even the one that everyone talking about with Hems took a beating. I already know Hems numbers, so I'm not suggesting people buy the stock, but maybe it's been underpriced and that could be an opportunity for you.
Hmm.
Same with the consumer staples. You know, these are the sectors. The consumer staple sector essentially is going to be the recession re. Yo, damn. Recession. Yo, I'm
Recession.
struggling. Recession resistant. You feel me? Oh my god, but it's
Recession
gonna be.
resistant.
I was about to start punching my monitor. Oh my god. Um, but
Yo.
the recession resistant. This recession resistant staple, because we all need groceries. We all need to go to the store. We all need to buy the daily goods that we need on a day to day basis, and that's not gonna go nowhere. These are the WalMarts. These are the Targets. Targets got beat up a while back. So that's always going to be recession resistant, but it's also going to be a place where people run a safety, like Wolf said earlier. So you're going to see things like Walmart right now up 13% year to date. That's because of the volatility right now. And then you
Mhm.
got sectors like AI, the tech sector, the QQQs, all this. you'll see companies like TSMC posting 35% revenue surge, but then you'll see the whole sector is in a correction level territory, meaning the whole sector is down 10% or more. So this is a prime example of, hey, the market's scared, but these stocks are performing still. You know what I'm saying? So we're gonna talk about that a little more. And then also we got our utilities, our realty incomes that pay steady dividends. That's also gonna act as another sector where people run the safety to because hey, I could buy this stock and get a quarter monthly dividend with realty and not have to worry about any volatility. So people are gonna run to those sectors. And then defense. Defense is one of those things where we know the government is always going to spend money. So this is another sector that people can run to for protection. Either it be the Lockheed Martins, either it be the there's one the I forget it starts with an R. Uh I forget the name of it, but there's another one. The
Raytheon.
Raytheons. Yeah, that was one. The Raytheons, Palantir, which also falls into the software sector, which is pretty funny. But these are the
Mhm.
companies that you people know the US is going to spend money on, so they're going to run to these for safety. But with these high conviction sectors, like I said, we want to look for the undervalued opportunities. Boom.
Yes, sir.
So boom, D Wall, how you find these sectors, right? I got y'all right now. What we're going to use is a thing called FinViz. And Mike actually mentioned them earlier. FinViz is actually a great website that has a bunch of different resources, but one of them is also called a heat map. All right. So I'm
Facts.
going to show y'all exactly what that is, right?
And it's free.
And it's free. Best part. So this is FinViz, y'all. FinViz. I don't know who owns Fin. Is it Charles Schwab, bro, or is that just an ad? I don't know.
Yeah, I'm
Uh,
really not sure.
yeah, I have no clue where they came from. I don't know who owns them, but I know they fire, right? So
Hmm.
here is what we call a heat map, y'all. And a heat map pretty much has all the sectors of the stock market in a map like this, so you can see everything in one place. So here you'll see the technology sector. This is all the big technology companies, right? And each sector, the technology side, the size of the company pretty much tells you how much weight that company holds in that sector. So you'll see Nvidia is huge. That means Nvidia is huge in the technology sector. So when Nvidia goes up or down, you should expect the whole sector to react to it. Same with Microsoft, same with Apple. But to find the opportunities, what you want to do is go here. Right now, I have it set to look to performances of drawdowns that are from the 52-week high. So that means these percentages are the percentages companies are down from their 52-week high. All right. So that means Microsoft, they
Oof.
was at their 52-week high. They're down 33% from their 52-week high. What else is in here? Oracle is down 60% from their 52-week high. I don't know how y'all feel about Tesla. That's down 30% from their 52-week high. Meta, aka Facebook, is down 20% from their 52-week high. So if you're talking about finding the companies that are beat up for no reason, no reason meaning people are emotional about the macroeconomic things, but these companies are still putting up good earnings, this is where you find it. Even Nvidia, it's down 11%, and they're damn near going to be a $10 trillion company in maybe 5 to 6 years, allegedly. Don't hold me to that, but they going crazy. All right.
Right.
So if you're
Wow.
talking about finding value, this is where you could find it. You use this website. You say, okay, Meta is down 20%. That's if we're talking specific statistics. That's in the bear market territory. We are down 20% or more. So now going back to the presentation, well, whoops, we identified the red zone, right? We identified, okay, Meta is down 20%. Let me now research the fundamentals. And this is where you dive into the company's financials, their earnings, and their overall um their catalysts, their news that's going on. So that way you can then make an educated decision on if Meta being down 20% in a bear market territory actually makes sense. Did anything change to cause that? And to do that, y'all can use the Yahoo Finances. Y'all can use all these resources to look into their actual documents. But in my opinion, you want to make it short, sweet, and easy. We got AI, y'all. We got Gemini, we got Claude, we got ChatGPT. You can go into ChatGPT or whatever you use and type in, think like a professional stock analyzer. Give me the full breakdown of Meta's company's financials, earnings, and sector outlook in simple terms. And it'll do it for you. Boom. It'll have you understand it in a way where you're not reading the words. You're like, what does that even mean? No, because now these AIs are allowed to train your mind to have you understand it in a way where you kind of feel like, okay, I'm confident in this stock, or the fundamentals actually change with the stock. Make it easy for yourself. And then, let's say in Meta's case, ChatGPT says, yeah, the stock market's bugging. This company has made $500 trillion. They're crazy good. They got good money. Now you make a decision. Okay, do I act on this discount? Do I dollar cost average? Do I buy the dip? What do I do here? But it all starts with the Finviz sector heat map and just looking at what's the most red and figuring out, does it make sense? Feel me? These are great tools that Wolf and I use, and it makes it easy for y'all. Make it easy, simple, clear, and cut.
All right. All right, fam. So, bro is just dropping. Now, you want to take all of this information, right? You want to understand how this works when it comes to dollar cost averaging and also understanding advanced entries, right? So, a quick recap, we talked about it a little bit in volume one. Now, dollar cost average just means that you're investing a fixed amount of money on a regular scheduled basis, no matter what the market is doing. So when the market is up, you're still investing. Where the market is down, you're still investing, but now you're buying it at a discount. Okay. So we want to talk about different types of dollar cost averaging. So the standard version is just you're investing a fixed amount on a regular schedule. It's super simple. You're not thinking about it. You're being consistent with it. You're not using any type of emotions because you don't care what's happening. It's being automated. It's happening automatically. And then you also have that long-term wealth mindset. Okay. This is something that a lot of people already are doing and they don't even know it. For example, when you have your investment account, your retirement account. So your 401k, if you're having through your job, you're most likely dollar cost averaging, you know,
Yep.
and you probably don't even realize it. So this is something that you're doing no matter what, especially if you're working for a company that's providing with the 401k. Next, you have your value based dollar cost averaging. So this is usually when you may start to increase some of your contributions when the market is dipping significantly, especially like times like now. So another thing to this too is that you may also scale back when it's overheated. So if the market is hitting all-time highs, you may want to chill out a little bit on, investing regularly into the market. Now, you still have the same discipline. It's just a little bit better of an execution. So it's just one level up from the standard dollar cost averaging because you're a little bit more involved, right? Now, we also want to understand lump sum investing versus dollar cost averaging. Now, if you have a lump sum of money you're dumping into the market, especially when it's down, statistically, you do win a little bit more, right? But when you are dollar cost averaging, psychologically, it makes more sense because when a market becomes volatile, now you're not thinking about it. You're still going to win no matter what when the market starts to recover. So it's just really important to know when each one of these scenarios makes sense, especially in different situations. All right. Lastly, is the RSI based entries. So the RSI is the relative strength index, and bro's gonna pull up a tab for that. But you definitely want to use this when the RSI is showing certain levels. So if it drops below 30, that means that the market is starting to become oversold. Does this mean if it hits 30, the market you automatically is going to bounce from that level? No, it does not mean that. It just means that once it gets to that level, you may start to just start dollar cost averaging because now everything is at a discount, right? So and then there's also level above too. If the RSI hits that level, maybe overbought. So it's just a good way of having a better entry, all right. And obviously, it's not day trading. This is more for a long term outlook and how to be more strategic when it comes to adding or getting out of a position.
That's a fact, bro.
Yes,
So
sir.
boom, like brother Wolf said, we gonna get into a live demo real quick. They're showing y'all exactly what that looks like. Okay.
Yeah.
So boom, y'all seeing my screen or still on the presentation?
Yeah, it's still in the presentation.
Okay, but let me do this. We're gonna go here. Boom. All right. Y'all seeing my screen?
Perfect. Perfect. Yep.
Awesome. So this is a perfect example of what oversold can look like, y'all. So let's ignore everything else, right? Because technicals, we have videos in the Discord breaking down all these lines and the technicals and all that. But let's focus on this bottom piece right here, where it says RSI, right? So what Wolf was talking about, the oversold and overbought levels, essentially show between these yellow lines, right? So this yellow line here below it means that a stock is oversold, meaning that typically when it gets below here, you'll see a stock rally because people are buying it since it's technically oversold based on the RSI. Compared to overbought that Wolf was talking about, which is at about 70, this is where stocks are overbought and people actually start selling at. So to make it easier for y'all, let's say you go through, let's go back to Meta. You go through Meta, you see, okay, cool. They have great fundamentals. They're down in a bear market. Let me check their RSI. And you see that the RSI is also below 30. That's just more confidence and more indicators for you that this is a good time to start dollar cost averaging or whatever you would like to do. Lump sum, but doing it smartly, etc. So a prime example of this is actually this stock CRM, which is Salesforce, and Salesforce actually is in the technology, the software technology sector, and they've been taking a beating because of AI. A lot of the software companies have taken a beating because they think AI is going to destroy all software. So this is exactly what it looks like. Y'all don't have to look at the MACD like this or the volume or the support lines or the averages and all that. You could just look at the RSI. Hey, it's oversold. It's a strong company and it's down because of this headline that doesn't really correlate with the company. This could be a good opportunity. Boom. There's your thesis right there. So
Absolutely.
just a just a quick thing to show y'all. It doesn't have to be complicated. It doesn't have to be difficult. All you got to do is look into that, and you're good. Let me get back to the
Absolutely. And
presentation for y'all.
yeah, and one thing you want to realize too is like when he was showing the RSI, you also want to realize that in that RSI example, there was an area where it was still oversold. All right. It bounced a little bit, then it went even lower. So we definitely just want to make sure we reiterate that this can't be your only tool or indicator to use when it comes to trying to buy a stock. There's never that one magic indicator that's just going to change your life. The stock market doesn't work like that, family. So there's always going to be more than one factor that plays into what's a good thing to buy and what's not a good thing to buy. So having that is just one little piece of your bag that you can add to your little arsenal when it comes to buying the stock or knowing when something is an opportunity. All right. So I just like to make that really clear. Someone to learn a new indicator and they be like, yo, this is it. Like this is all you need, and then you'll make $1 million. It doesn't work like that, family. So just make sure
Yep,
you have that mindset so that way you're not just setting yourself up for failure.
absolutely. That's a great point. I hope I'm happy you brought up, bro. There is no indicator out there that's gonna tell you perfectly every time what to do. There's nothing like
Yes.
that. Technicals are purely to educated guesses. That's what they're used for. It support your educated guess and around your thesis. That's all it is. But it cannot predict exactly what's going to happen to a stock. No one can. I don't care. Unless you are AI, no one can. Maybe AI gets to a point where it can do that. But as far as humans and technicals, we're not able to do that yet. But it can
Right.
help you a lot to dictate how close we are to the bottom and how close we are to the top.
That's real talk. That's real talk, family. And we got over the RSI. You definitely want to make sure that you're also identifying support levels. So support and resistance. That's definitely name of the game for real when it comes to the market. That's pretty much what RSI is as well. But you need to know where the floor is on that stock. All right. If a stock is at $100 and every time it goes down to $50, it bounces from there, that's your floor. And you're sealing it every time it gets to 120, it kind of pulls back, that's your ceiling. So you definitely want to make sure you always can identify your support levels. And then lastly is just how to always read those certain signals that you're using. That way you can always have a higher probability when it comes to entering into a stock and also selling it as well.
Absolutely, yes, sir.
Yep.
So boom, we went over some technicals, RSI, and I was up with position sizing, right? How to not get wiped. 'Cause y'all be forcing it. All right. So boom.
Phew.
This is the number one mistake, bro. Like people be putting everything, they left leg, they son's kidney into one position, right? And particularly, yo, I'm forcing it. A son's kidney is crazy. But,
So wild. Yeah.
but our rule overall is to never put more than 20% of your buying power into a single trade. And when I say buying power, I mean exactly what you have in your account as far as cash. Okay. So, prime example. Let's say the chart I was just looking at. Let's say I want to take a chance on that what was it
Salesforce.
Salesforce. Yeah. Let's say I wanted to take a chance on Salesforce and I felt confident on that trade because the RSI was there and it was bouncing off of support, whatever, right? I'm not putting 50% of my cash, my buying power into that play. If I'm super confident, I'll put in up to about 20%. This is after deep research, going over Salesforce fundamentals, and a long term belief in the company, right? And this is for a trade. Either it's like let's say I'm trading it for a swing for 6 months out, or a leap where I'm buying an option contract for a year out. This is exactly what I'm willing to put up. It's only 20% of my buying power. Now, same thing. Let's say it was another trade, and I was like, I'm not too confident in it, but I still want to try something out. You could put 10% of your buying power into it. Or if you're just like, y'all see, it's early. I don't know how I feel about it. It's a volatile play. I'm going to put 5% in. You can do that too. But the main thing is you do not want to put more than 20% into a trade because if you do, if that one stock drops 20% and you put 50% of your buying power into it, let's say you put in $1,000 in your buying power, 50% of 1,000 is 500. You just lost half your buying power on one trade.
Hmm.
And the game is longevity, y'all. It's not get rich quick. And that's not how you found build a foundation for longevity. So 20%, do not put more than 20% of your buying power into one trade. Now, to help y'all with that, we actually have a thing called a position sizing calculator, right? So I'm gonna switch tabs real quick just to show y'all. Boom. Y'all able to
Quick
see this
math, quick
calculator
math.
right here? Quick math. Facts. So boom, this is our position sizing calculator. If you're in the Discord, you're gonna be getting this in our education tab, our beginners tab. But essentially, we made it so that way it's simple for y'all. So this problem example. Let's say for my total portfolio value that I have in my buying power, let's say I have $1,000 in my buying power, right? It'll tell you that okay, if you have $1,000, that means the max you could put into one trade is $200, and that's for high conviction. If you're not that high on it, the max you could put in is 150, and if you're low on it, the max you could put in is $50.
Mm.
So it makes it easy for y'all. So that way you don't gotta pull out your calculator, press a bunch of buttons. You don't gotta do all that. But also, let's say I have $1,000 and the share price is $100 a share. It'll also tell you how many shares you can get based on your conviction level. All right. So
Fire.
if I have high conviction, that means for my max 20% of $200, I could buy two shares. If I don't, I have 150, I could buy one share. With $50, I can't even get any shares. So at that point, I might as well just stand down. Unless I want a dollar cost
Hmm.
average, $5 a day up until $50. But this calculator just makes it easy for y'all. So that way you don't have to go through the emotions of it. You can just purely go off of the numbers. And that's what comes down to trading and investing. What do the numbers tell you? And the fundamentals. All that other stuff, the feelings and emotions, let other people feel that. Here you gotta be a robot. Be stone
Hmm.
cold Steve Austin. I don't know if that's a good example, but y'all know what I'm trying to say. You feel me? Stone cold. Did he die? He's still alive, right? I think he's still alive. Shout out Steve Austin.
Bro, I was just thinking that in my head. I'm like, damn, did he just die? Nah, I think that
No
was some
air.
overdose though.
Man, everybody died. That's tragic.
First of all, other one too. That the calculator. Come on, if you in a Discord, like, come on, you got your own thing to do with calculator, fam. Like, hey, it don't get no better than this, family. You know, whoever would have thought things were up with their own little investing calculator. That's pretty dope, if you ask me.
Hey, God is good, man.
Nah, that's tough though. I mean, like bro was saying, there's definitely a lot of it's a lot of numbers that it may seem to be overwhelming sometimes, but this is why we're doing this to make you understand that it's super simple, and we're definitely going to give you all the tools to make sure that you're really not thinking. We want you to become a robot when it comes to investing. There should definitely be no emotions involved in this, because as soon as you bring that into the picture, that's when you start to make some mistakes, because then you're like, all right, you start to think too hard about it. You start to not involve numbers, and as soon as you start to leave the numbers out of it, that's when it starts to hit the fan. All right. Now, with this one, we want to talk about exit strategies and rebalancing, because no matter what, you can buy anything. If you don't sell, or if you sell at the wrong moment, it doesn't matter what you just did. You just lost money. So it's really important to know how that works, because buying is easy. You know, it's super easy to go to the mall, buy a pair of Jordans, but then what if you're trying to resell those Jordans? Somebody say, "Yo, I'm gonna buy it off you for 100, but you bought the Jordans for 150. You didn't really do nothing. You know, you just lost money." So it's really important to know when to sell and when to buy. Now, your trigger one is knowing when your thesis is broken. So the reason you bought no longer applies. The fundamentals changed, leadership shifted, the sector outlook was reversed. For example, software sector. Everyone was loving software. But soon as AI came around, software was like, yo, I need to get out of this now because I'm just falling with the shit. So you really need to know when the thesis has changed, because it could happen literally overnight. Even what was the example with Google, when AI came
Yes.
out and Google sold off crazy in like one day. But at that same as that time, imagine if you would have just sold just because of that one headline. Google ended up rebounding because they came out with their own AI. So there's always like this happy medium between it. And you just need to make sure that you're always doing your own research and seeing when something is fluff and when it's not. All right. Trigger number two, you hit your target price. Now, you need to always set a goal. Did the stock reach a certain number? You're looking for 20%. All right, you made 20%. Take your profit. All right? Because if you don't take your profit, that greed is going to kill you. It's happened to me so many times, family. I'm not perfect. It's been so many times where I've hit my profit numbers and I don't take my profit. And when that happens, it'll go right back down to where you're looking not to be at. So discipline is probably the most important thing, especially when it comes to day trading. So discipline is always going to be that core piece of your mindset when it comes to making money in the stock market. Trigger number three is the allocation, which is being drifted too far to a certain area. So whether it's down or to the upside, make sure that you're rebalancing that. So actually, we could get into the next one. So that's the way we just show it.
Facts.
So speaking on that last slide, right? So this is just an example where it says your scenario, and right under where it says what happened to your asset allocation. So first, let's talk about like your core portfolio. So 65% is going to go towards ETFs, 20% towards individual stocks, 8% towards crypto, and 7% towards cash and options. Altogether, that equals 100%. So let's say with those targets, right where it says after drift. So what if you had an ETF? This is just an example. You had an ETF that's a 65% target, but it pulled back to about 52%. In that ETF, you now want to start adding to it so that way you can get back to that 65% target. Now, with the individual stock example, if your target is 20% and it's gone up now to 33%, you want to trim from that position, all right, to get yourself back to your target. Now, if it's a runner, it's a runner. Let it run for a little bit. But then when you start to see signs of being overbought, now let's start to trim a little bit, take some profit, lock it in. Same exact thing with crypto. You're at 8% and it drifts to 10%. Crypto is pretty volatile too, so it could drift to 20, 50% really quick. take profit, do a slight trim. And it's the same with cash and options. If your target is 7%, it's gone down to about 5%. You can add to those positions. All right. Now, we already pulled up the portfolio visualizer. Another thing you want to do is just identify which buckets are overweight and which buckets are underweight. That's probably the most important thing, and you can use a portfolio visualizer for that. Also, if you have like a Thinkorswim, Robinhood, it's pretty easy to see where your money is being allocated to. So definitely always check that out. Always trim your winners, sell enough if it's overweight on certain positions to bring them back to the target and lock in those gains. And then always add to any underweight positions so that way you can make sure that you're capitalizing off of any big time runs. If you just go back to that last slide really quick, there was one part that I want to touch on that was in there. All right, perfect. So on the bottom where it says emotional selling versus strategic selling, this is super important. This is what I talked about with that Google example. All right.
Yup.
You need to know the difference because you could panic sell and it's not a part of your strategy. We're not panic selling. What's that mean? It's like diamond hand. I think it's what like Bruce Lee or something. He put the diamond
Yup.
hands up. Not a panic seller. So we can't be panic sellers here, family. You got to be able to have straight logic and straight strategy when it comes to the market. Soon as you panic sell and you don't follow your rules, if you got out when you wasn't supposed to, if you're at a certain loss where it wasn't even that bad to your portfolio, you're going to regret it if it starts to go the way that you wanted it to go the entire time. That's the worst thing to do. Because now if you get out of a play, it's going down 10%, but you had about 20% downside to, deal with. And then it goes up 100%. Now the next time you're in that situation and you go down 30%, you're like, yo, let me just hold on to it because last time it went up when it did this. And now you're just all over the place because you're not being disciplined. You're just going off of emotions. So it's really important to understand the difference between being an emotional seller, even an emotional buyer, and a strategic seller and a strategic buyer as well.
Absolutely, bro. And that's a chime in too. Just to make sure like y'all understand. Like there's a difference when it comes to allocation and rebalancing when it comes to trading and just dollar cost averaging and buying shares, right? So
Right.
like so for what we're talking about here with the ETFs and the individual stocks and the crypto, we're always holding on to something, you know? For example, with the after drift, with the individual stocks, we were up 33%. We sold and trimmed that back down to 20%, but we didn't sell everything. All right.
Right.
But with options, it's a little more stricter. When we have, let's say we're doing a option contract, a swing trade out to let's say September. Our big thing is once we hit that 20%, we're gonna sell off most of our contracts and maybe leave one runner. But we're not gonna be holding our option for very long compared to how we're gonna hold our actual stocks. Okay. So that's one thing to keep in mind. With trading, y'all be a lot more stricter with what you how you're selling it and how you're cut trimming and all that. But with stocks, you can hold on to those because you're owning an asset.
Facts, bro.
Yes, sir, buddy. All right, we got the fun stuff, bro. We got taxes. For me, so again, this is not financial advice. Talk to your tax accountant. Y'all got free consultations everywhere. You can find it through Google, whatever. But most beginners don't think about taxes until it's too late. You know, a lot of people made a killing last year. I have a friend who had to pay 18,000 because of last year in taxes, and that's what we got to understand: the short term versus long term capital gains, right, yo? So, capital gains is essentially the tax that you're gonna have for any type of asset that you invest into, either it be stocks, either it be a house, either it be even if you get things passed down to you and they're not set up properly, you have to pay capital gains on those. It's just pretty much the government saying, "Hey, you made money off an asset. I need my cut though, or some Debo stuff." You feel me? So,
Mm-hmm.
but there's two different variations of it depending on the holding period. So let's say if you're like us and you swing trade and you do some day trading, that means for trade specifically, our holding period is less than 12 months when it comes to option contracts. So for example, for me, for my slight trading that I did last year, and I just did my taxes, I had to pay or forego some of my what's it called, my return to this short-term capital gains tax rate of 22 to 37% because I was trading. All right. But that's why we'll always say trading is for cash flow, while long-term buying and holding stocks is real wealth building. Because if I actually were to just not trade at all and just buy stocks at dollar cost average and hold for more than 12 months and not use no options or nothing, I would have had to pay way lower than what I had to pay with this tax rate of 22 to 37%. So that's one thing we have to understand, y'all. That's why we always advocate for you to have separate accounts. You can have one account that's meant specifically for buying and holding stocks and you believe in and ETFs, and another account that's specifically just for trading options. So that could be your 5%, and the ETFs and stocks and all that could be your 60 and 20%, like we talked about with the allocation stuff. So that's something to keep in mind, y'all. That helps a lot when it comes to tax time. But also using the accounts that have tax advantages to your advantage. A prime example is a Roth IRA. So for y'all that don't know, a Roth IRA is an account that allows you to invest money that was already taxed. So that way, when you take money out of it, when you come to retire, I think at like 65, you aren't taxed again. So you're having tax free growth. So that's one of the strongest accounts out there. And it works just like a brokerage account. All you have to do is open it. You go over to Robinhood, Fidelity, whatever. You open it, you put money into it, and the money you put into it, you invest into it. You invest into assets like you would any other brokerage account. Okay. While a traditional IRA is actually the opposite. Instead of tax free growth, you're tax deferred. So that means everything you put into the account is deducted from your taxable income. So let's say you make $80,000 a year, but you put in 20, well, not that's over the cap, but let's say you put in $10,000 into a traditional IRA. That means you actually made only $70,000 to the IRS because you're deducting that 10K from that 80K since that 10K is tax deferred. So you can save money through taxes through that account. There's so many different tax advantage accounts that it's important to leverage those so that way you're saving yourself from these capital gains tax. Because a lot of people, especially us young people, don't think about it, and then we get screwed by the time of now, where it's April 15th coming up, tax day, and you're like, damn, I gotta pay 15, 18, $20,000. But there's also a strategy called tax law harvesting that can be beneficial as well. And this is where you have a loser. All right, let's say you have a loser and it's killing you. For me, you down 3 bands, 4 bands, you're stressed. But in reality, what you can actually do is have that be a loss on your statements through your brokerage. So that way now that same 3,000 can actually be used as a tax deduction on your taxes. So that's what a lot of people do. They'll see they have a losing position and they may not hold it for long. They may not sell it off automatically. They may hold it for a bit, but they'll say, okay, I'm just gonna use this as a tax law harvest when next year taxes start. Because now, let's say they sell it off before the next tax year kicks off. Now that's gonna be $3,000 they can deduct off of the taxes to save money off the tax bill. So it has their benefits. Even the losers have their benefits, which is the crazy part about the stock market. But the biggest thing overall is you want to follow the 12-month rule. And that's pretty much saying before you selling any winning position, you're selling a losing position, whatever the case may be, you want to ask yourself, did I get this contract within 12 months of my purchase date? Meaning, am I within the 12 months? So that means for my holding period, that I hold this for more than 12 months and less than 12 months. If it's less than, maybe you should consider waiting few more weeks just to save a couple hundred thousand of dollars on your taxes because you're going to be in a different holding period tax rate. If you held it for more than 12 months, now you can have some at ease. You're still going to get taxed, but it's going to be way less than what you would have gotten if you held that stock or that option contract for less than 12 months. So yeah, taxes is weird. It's complicated. But hopefully, this process breaks down a little bit more so you can use these accounts, tax law
One
harvesting, and the 12-month rule to your advantage.
one thing I want to let everybody know too is like the tax loss harvesting that you should definitely know. And obviously, this is not financial advice, family. But when if you try to if you sell a position right to lock in a loss, make sure that you don't just buy it right back thinking that's going to be locked in
Mm,
for when your taxes happen. Because there's also a rule that you need to hold that loss for a certain amount of days or a certain amount of weeks before that could be deducted from your taxes. So if you
yeah.
sell Google, let's say for example, for a $2,000 loss, and then you go and buy some Google Leaps the next day to try to offset it, thinking that you might get a write off, the IRS may say, "Hey, you just bought a similar asset to that. We're not going to deduct that as a loss because you tried to." I think it's called like a wash rule or something like that.
Yeah, wash rule, bro. That's what it is.
Yeah, so just make sure y'all know that because a lot of people may think, "Yo, I got a little workaround for it." No, the IRS is going to know. Trust. So
Mm.
just know
And that's
how
what.
that works. Do your own research.
Yep. And they're specific with it too. When I was doing my taxes, they was asking about that. So ain't no hiding from them kids. They the big OGs. I ain't gonna lie.
Nah, for real. Fire. Lit. Wow. So, family, the blueprint is complete. You now have a portfolio for 2026, also entering into 2027. That sounds crazy to say. Wow, we're almost at
Wow.
2030. It's crazy. All right, so you're not doing random stock picks, family. This you now have a system. If you're in the Discord, you're gonna have this entire blueprint, this entire presentation for y'all to use. You can plug this whole entire thing in the Chat GPT, have it create a little personalized system for you if you want to. Just giving you some tricks that you can use, family, or you can just use this slide, share it to some of your family as well. Now, some of the things that we went over, I just want to go through it one more time, fam. Asset allocation, knowing where your money is, and you're structuring it intentionally based on your risk tolerance and timeline. Your core model, 60 to 70% is going towards ETFs, 15 to 20% is going towards individual stocks, 5 to 10% going towards crypto, and 1 to 5% is going towards cash and options. Number three is your overall strategy, finding undervalued strong companies, using sectors as context, knowing which sector is hot, which sector is not, fundamentals as your core decision behind anything, making sure that you're being disciplined and following your rules. Number four is dollar cost averaging, having those advanced entries on point, knowing how to use the RSI, knowing the bottom floor of where a stock is bouncing, knowing when the stock is being rejected as a ceiling. Also, number five, position sizing, never putting more than 20% of your buying power in one trade, being super strict, not using your son's kidney or your daughter's kidney to buy a play. That was a crazy one, bro. It's wild. And then
Uh,
also having the exit strategies in place, family. So those three triggers to sell, rebalance quarterly, knowing the difference between emotional and strategic selling. And then lastly is the taxes. Uncle Sam does not play. He's going to know. He knows when you're sleeping. He knows when you're awake. You better be good for now play. Use the Christmas
you ain't
line,
lying
y'all.
though. Hey, they will
Nah,
come to
but
your door.
they will knock on that
Wow.
door respectfully and take you out your bed. No, so
Mm-hmm.
you got to know what happens when you're holding for more than 12 months and when you're not, and also how tax losses work. So this entire system, family, should definitely take you to that next level when it comes to your financial well-being, and also make sure that you just start growing for when it comes to generational wealth as well.
Facts.
Yeah. Now, lastly, we definitely want to make sure that we're opening the floor for anyone. I got the YouTube up, got the comments up as well. We really just want to make sure that this is a video that's already out there. This is definitely for our Discord. If we see any questions go through, we're going to answer them, but it's definitely a time for any Q&A. Even after this video, if you got any questions, still put them in the comments, and we'll make more videos that could, go off of this as well if there's anything that we didn't touch up on, you know? Yeah, bro. So it was a good amount. We started at it was probably a little over an hour. So it's just some good information in there, family. I'm hoping that y'all definitely took something from it. We really hope that y'all could at least like, comment, reshare this so the algorithm can show us some love. It's not some BS that we're teaching here. This is something that's super important. So we really want to make sure that we get this message out for everyone.
That's a fact, bro. We gotta teach everybody, man. There's real ways to get to this bread, y'all. So we here for it, bro. So any questions, anything that y'all need, either in the Discord, comment section, live chat, we here for y'all, man.
Real talk, bro. It's the legal way. You know what I'm saying? And who don't want
Legal
that?
facts, legal cheese. That's great.
It's great. I can sleep at night. It's wild.
Mm-hmm. Facts, bro.
Like, oh, yeah, man. I'm just looking through the YouTube now, see if I see anything. It's definitely gonna be one of these videos where a lot of stuff will start coming in after the fact, which is fine.
Yeah.
Yeah, I think I'm good though, bro. You good?
Yes, sir. Love, man. Always a pleasure, y'all.
Always. Peace out, family.
Yes, sir.